Before we dive in, a quick but important disclaimer. I am not a licensed financial advisor, mortgage broker, or attorney. This presentation is for informational and educational purposes only. The information provided is not, and should not be considered, legal or financial advice. Buying a home is one of the biggest financial decisions you'll ever make, so please consult with qualified professionals before making any decisions based on the content of this video. Picture this: you've done it. You found the perfect house. The one with the big backyard for the dog, the updated kitchen, the home office you've been dreaming of. You've scrimped and saved for years to get that down payment together. You went through the stress of getting pre-approved. You negotiated like a pro, you beat out other offers, and your offer was accepted. You are at the finish line. You can almost taste the champagne, you can almost feel the keys in your hand. And then, a few days before you're supposed to close, your lender sends you a 5-page document called the closing disclosure. You scan through it, and your heart stops. Right there, at the bottom of the page, is a number. A huge number. $5,000, $8,000, maybe even $15,000, labeled total closing costs. And your first thought is, where in the world did that come from? I already have my down payment. This is the moment where the dream of homeownership can feel like a financial nightmare. It's a moment of panic, confusion, and frustration for millions of Americans every single year. That feeling stops today. The single biggest mistake most homebuyers make isn't choosing the wrong house, or even the wrong interest rate. It's walking into the closing completely blind, not understanding this document, and paying thousands in unnecessary or inflated fees simply because they don't know they can question them. By the end of this video, that will not be you. You will understand what closing costs actually are. You will be able to identify every single line item on that disclosure, and most importantly, you will know exactly what to look for, what to question, and how to potentially save yourself a significant amount of money. We are going to demystify the entire process and turn that feeling of panic into a feeling of power and confidence. So, what are these mysterious costs? In the simplest terms, closing costs are the collection of fees you pay to finalize a real estate transaction and officially take ownership of a property. Think of it like this. Buying a house isn't like buying a TV. You can't just swipe a card and walk out with the keys. There's a whole army of people and services working behind the scenes to make the sale happen legally and securely. There's the lender who's giving you the massive loan, the appraiser who makes sure the house is worth what you're paying, the title company that ensures the seller actually has the right to sell it to you, and even the government which wants its cut in taxes. Closing costs are simply the fees you pay to everyone in that army for their services. The reason it's so confusing is that it feels like death by 1,000 cuts. You don't get one bill for closing. You get a long list of 20 or 30 different cryptic-sounding fees. Application fee, underwriting fee, title search, escrow fee, recording fee. It's a mess of financial jargon designed to make your eyes glaze over. But here's the secret. Almost every single one of those fees can be sorted into one of 3 simple buckets. Understanding these 3 buckets is the key to understanding everything. Bucket number 1, lender fees. These are the fees your mortgage lender charges you for the service of creating, approving, and funding your loan. Bucket number 2, third-party fees. These are fees for services performed by other companies that your lender hires on your behalf, like the appraiser or the title company. And bucket number 3, prepaids and escrow. This isn't really a fee, but it's your money being set aside to pay for future expenses like property taxes and homeowners insurance. For the rest of this video, we are going to do a deep dive into that first, and often most negotiable bucket, the lender fees. This is the profit center for your bank or mortgage company. It's where they make their money directly from you for the service of giving you the loan. Let's break down the most common ones you'll see. First up, the big one, the origination fee. This is the lender's primary charge for processing your loan application and creating the mortgage. Think of it as their main commission. You'll often see this expressed as a percentage of the total loan amount, typically ranging from 0.5% to 1% of the loan. So, on a $400,000 loan, a 1% origination fee would be a whopping $4,000. Now, here's the crucial part. This fee is highly negotiable. Lenders sometimes bundle a bunch of smaller fees into this one big fee. Other times, they might charge this in a bunch of smaller fees. Your job is to ask. If you see a high origination fee, ask your loan officer, can this be reduced? Or what does this fee cover? Sometimes a lender might offer you a no-cost loan, but be very careful. There's no such thing as a free lunch. They usually compensate for waiving the origination fee by charging you a higher interest rate over the life of the loan, which could cost you far more in the long run. Another term you'll hear tied to this is points, or discount points. This is one of the most confusing things for first-time buyers. Buying points is essentially prepaying interest upfront in exchange for a lower interest rate on your loan. 1 point typically costs 1% of your loan amount and might reduce your interest rate by about 0.25%. So again, on that $400,000 loan, 1 point would cost you $4,000 at closing to lower your rate. Is it worth it? That depends entirely on how long you plan to stay in the home. You have to calculate your break-even point, the point at which your monthly savings from the lower interest rate have paid back the upfront cost of the points. If you plan to sell or refinance before that break-even point, you've just given the bank free money. Next on the list of lender fees are the administrative charges. You might see an application fee, a processing fee, and an underwriting fee. Let's tackle these. An application fee is a charge just for applying for the loan. Honestly, in today's competitive market, this is becoming less common. If you see it, you should absolutely question it and even consider shopping around for a lender who doesn't charge one. Then there's the processing fee and the underwriting fee. These sound similar, but they're for two different stages of the loan approval process. The processing fee covers the cost of gathering all your paperwork, your pay stubs, your bank statements, your tax returns, and putting it all into a neat little package for the underwriter. Think of it as the clerical work. This fee can run from $300 to $900. The underwriting fee is for the underwriter themselves. This is the financial detective, the person who actually analyzes your file and makes the final decision to approve or deny your loan. They are assessing the risk. Are you likely to pay this loan back? Is the property a good investment for the bank? This is a critical job, and the fee for it usually ranges from $400 to $1,000. Now, can you negotiate these? Sometimes. Some lenders will tell you these are fixed administrative costs, but it never ever hurts to ask. You can say, I'm comparing offers from a few lenders, and your processing and underwriting fees seem a bit high. Is there any flexibility here? The worst they can say is no. But in a competitive market, they might just be willing to reduce them to win your business. Finally, you might see a rate lock fee. When you're approved for a loan, your interest rate isn't set in stone until you lock it. Because interest rates can change daily, a rate lock is a guarantee from the lender that they will give you a specific interest rate for a certain period, usually 30 to 60 days while you close on your home. Most lenders will offer a free rate lock for a standard period. However, if you need to extend that lock because your closing is delayed, they will likely charge you a fee. This is another area where you need to be proactive. As soon as you have a closing date, talk to your lender about locking the rate and make sure you understand their policy on extensions, just in case something goes wrong. So, to recap the lender fees: origination, points, application, processing, underwriting, and rate lock. These are the costs you are paying directly to the institution giving you hundreds of thousands of dollars. They are in business to make a profit. But you are the customer, and you have the power to shop around and to negotiate. Never just accept the first set of numbers they give you without asking questions. By understanding just this one bucket of costs, you're already in a much stronger position than the vast majority of homebuyers. Now that we've pulled back the curtain on the lender's fees, let's talk about the second major bucket of closing costs. This is where you pay for your pit crew. Imagine you're in a high-stakes race to the finish line, which is getting the keys to your new home. You can't do it alone. You need a team of specialists, each with a critical job to ensure your car, or in this case, your house, is sound, legal, and ready to go. These are your third-party service providers. They don't work for the bank and they don't work for the seller. They work to facilitate the transaction and, most importantly, to protect you and the lender from disaster. The first member of your pit crew is the appraiser. Let's be crystal clear. The appraisal is for the bank. It is not for you. You pay for it, but its purpose is to protect the lender. The bank is about to give you hundreds of thousands of dollars, and they need to be absolutely certain that the house they're using as collateral is actually worth that much. If you default on your loan and they have to foreclose, they need to know they can sell the house and get their money back. So they hire a licensed independent appraiser to go out to the property. This person is a professional valuator. They measure the square footage, count the bedrooms and bathrooms, assess the overall condition, and look at the recent sales prices of comparable homes in the neighborhood, the comps. They then compile all this data into a detailed report that gives the property an official appraised value. If that value comes in at or above your purchase price, everyone breathes a sigh of relief. If it comes in low, it can create a major hurdle that requires renegotiation with the seller or you bringing more cash to the table. The fee for this crucial step typically runs anywhere from $400 to $800, sometimes more for larger or more complex properties. You can't shop for your own appraiser. The lender has to order it through a neutral third-party system to ensure impartiality, but it's a non-negotiable cost of getting a mortgage. Okay, next up is the biggest, most confusing, and arguably one of the most important third-party services: title. This is a beast, so let's break it down. When you buy a house, you're not just buying wood, drywall, and a patch of grass. You're buying the legal right to own that property, free and clear of anyone else's claims. That legal right is called the title. But how do you know the person selling you the house actually has a clean title? What if their great-uncle twice removed claims he actually owns a third of the property? What if a contractor who renovated the kitchen 5 years ago was never paid and put a lien on the house? What if there are unpaid property taxes from a decade ago? Any of these issues, called clouds or defects on the title, could jeopardize your ownership. You could buy a house and then find out you've also bought a massive legal and financial headache. This is where the title company comes in. They are the detectives of the real estate world. The first thing you pay for is a title search. Their team dives deep into public records, deeds, mortgages, tax records, divorce settlements, court judgments, sometimes going back 50 years or more, looking for any skeletons in the closet. They are building the chain of ownership and making sure it's unbroken and clean. Once their search is complete, they issue a report. And this leads to the next fee: title insurance. Now, this is where people get really confused because there are two different kinds. The first one is a lender's title insurance policy. This is not optional. Your lender will require it and you will pay for it. This policy protects the lender's investment. If some long-lost heir shows up a year after you close and successfully sues for ownership of the house, the lender's policy ensures the bank gets its money back. But what about you? What about your down payment, your equity, all the money you've put into the house? The lender's policy does nothing for you. That's where the second policy comes in. The owner's title insurance policy. This one is technically optional, but I will tell you right now, not getting it is one of the riskiest gambles you can take in real estate. It's a one-time fee paid at closing that protects you, the owner, for as long as you or your heirs own the property. If that same long-lost heir shows up, your owner's policy is what pays for the lawyers and the court battles to defend your ownership. Without it, you could be out hundreds of thousands of dollars and potentially lose your home. It's the ultimate shield against the ghosts of a property's past. The cost for title services and insurance can vary wildly by state and home price, but it's often one of the largest third-party fees, sometimes running $1,000 to $3,000 or more. Don't skimp on it. Now let's talk about the third member of your pit crew, the home inspector. Please listen closely. The home inspection is different from the appraisal. The appraiser tells the bank what the house is worth. The inspector tells you what's wrong with it. This is your single best tool for due diligence. For a fee of usually $300 to $600, you hire a professional to spend hours crawling through the attic, walking on the roof, checking the foundation, testing the electrical outlets, running the plumbing, and firing up the HVAC system. They are looking for problems big and small. A leaky faucet, a cracked window, sure. But also a failing roof that's going to cost $15,000 to replace in a year. A furnace on its last legs. Evidence of termite damage. Foundation cracks that could signal a $30,000 structural problem. The inspector's report is your roadmap to the house's true condition. It's your single greatest piece of negotiating leverage. If the inspection reveals major issues, you can go back to the seller and ask them to make repairs, or give you a credit at closing so you can make them yourself. In a worst-case scenario, it gives you the power to walk away from a potential money pit and save yourself from financial ruin. I have heard absolute horror stories of people who waived the inspection to save $500 on a competitive offer, only to discover a $10,000 mold problem behind a wall a month after moving in. Do not be that person. Pay the fee. It is the best money you will ever spend in the home buying process. Beyond these big three, appraisal, title, and inspection, there are a handful of other smaller third-party fees you might see. There's usually a small fee for a credit report, maybe $30 to $50, that the lender pulls to check your credit history and score. There's a flood certification fee, which is just a company determining if your property is in a federally designated flood zone, which would require you to buy separate flood insurance. That's usually about $20. In some areas, you may need a survey where a surveyor comes out to officially map the property lines. This can cost several $100s. And in some states called attorney states, It's legally required to have a real estate attorney involved in the transaction to review documents and facilitate the closing. Their fees can range from $500 to $1,500 or more. So that's your pit crew: the appraiser, the title company, the inspector, and a few other specialists. These aren't junk fees designed to pad the lender's pockets. These are payments for essential independent services that ensure the home you're buying is valuable, legally yours, and physically sound. You are paying for protection and peace of mind. Now, you've paid the lender for their work and you've paid the third-party team for their expertise. But there's a third bucket of costs, and it's by far the most misunderstood part of the closing statement. This is the money that isn't a fee at all. It's your own money for your own future bills that you are forced to pay in a lump sum at closing. It's a category called prepaids and escrows, and getting this number wrong is the #1 reason homebuyers experience sticker shock on closing day. It's where you pay for things like your property taxes and your homeowner's insurance up front. And if you don't understand how it's calculated, you can be in for a very nasty surprise. So let's pull back the curtain on this thing called escrow. Think of it as a separate savings account that your mortgage lender manages for you. You deposit money into it every month as part of your total mortgage payment, and the lender uses that money to pay for two critically important things on your behalf: your property taxes and your homeowner's insurance. Why? Why do they force you to do this? It's simple, really. It's all about protecting their investment. The lender just gave you hundreds of thousands of dollars to buy this house. That house is the collateral for the loan. If you don't pay your property taxes, the county or municipality can put a lien on your property and eventually foreclose on it, seizing it to cover the unpaid tax bill. If that happens, the lender's massive investment, their loan to you, could be wiped out completely. They could lose everything. The same goes for homeowners insurance. If your house burns to the ground and you don't have insurance, the lender is left with a loan on a pile of ashes. They have nothing to recover their money from. So the escrow account is their insurance policy against you forgetting or failing to pay these crucial bills. It ensures the government gets its tax money, and the insurance company gets its premium, keeping the property lien-free and protected from disaster. It's a non-negotiable for most loans, especially if you're putting down less than 20%. Now, here's where the sticker shock at the closing table comes from. You're not just starting your monthly escrow payments after you close. Oh no, you have to pre-fund this account right at the beginning, at closing. This is what's called your initial escrow deposit. The lender needs to make sure there's enough cash in that account from day one to cover the bills when they come due. And they also get to hold a cushion. Federal law allows them to keep a buffer in your escrow account of up to 2 months' worth of escrow payments. This cushion is there to cover any unexpected increases in your property taxes or insurance premiums. So, right off the bat, you're paying for a few months of these expenses up front plus a 2-month cushion. And that adds up fast. Let's break it down with a real-world example. Imagine you're buying a home, and your estimated annual property taxes are $6,000. Your annual homeowner's insurance premium is $1,800. Let's add those together. That's $7,800 a year. To figure out the monthly amount that will be added to your mortgage payment, we divide that by 12. That comes out to $650 per month for escrow. Now for the cushion. The lender is allowed to keep a 2-month buffer. So, we take that $650 monthly payment and multiply it by 2. That's a $1,300 cushion they can require you to deposit at closing. But wait, it gets more complicated. The amount you actually pay at closing depends heavily on when you close and when the next tax and insurance bills are due. Let's stick with our example. Your monthly escrow payment is $650. Let's say you close on your house on April 15th. Your first mortgage payment isn't due until June 1st. So by the time the lender has to pay your first big bill, they will have only collected one payment from you, the one you made on June 1st. Now, imagine the county property taxes are due twice a year, on July 31st and January 31st. So that first bill for 6 months of taxes, $3000, is due on July 31st. Let's do the math from the lender's perspective. By the end of July, they will have collected 2 payments from you: your June 1st payment and your July 1st payment. That's 2 times $650, which is $1,300 in the account. But they need to pay a $3,000 tax bill. They are short by $1,700. And that's not even including their 2-month, $1,300 cushion they want to have sitting in the account at all times. So, to have enough to pay the $3,000 tax bill and maintain their $1,300 cushion, They need a total of $4,300 in the account by the end of July. They'll only have collected $1,300 from you in monthly payments. So, $4,300 minus $1,300 means they need you to bring a check for $3,000 to the closing table just to fund the escrow account. This is the math that blindsides people. They see this huge number in the initial escrow payment at closing section of their closing disclosure and have no idea where it came from. It's not a fee. It's your own money going into your own savings account, but you're forced to put it there all at once on closing day. That $3,000 on top of your down payment, on top of all the other closing costs we've yet to discuss, can be a brutal surprise. And that's just the property tax side of it. Let's talk about homeowners insurance. This is another major component of your prepaids. Lenders almost universally require you to pay for the entire first year of your homeowner's insurance policy upfront, at or before closing. So using our example, that's an $1,800 bill you have to pay in one lump sum. You can't pay it monthly for that first year. You pay for the whole year. And then starting in year 2, the lender will pay the annual premium on your behalf out of the escrow account you've been funding every month. So when you get to the closing table, you have to show proof that you've paid that first year's premium. That's another huge chunk of cash you need to have ready. So let's tally it up for our April 15th closing. You've got the $3,000 initial escrow deposit for future taxes, plus you've got the $1,800 for the first full year of homeowners insurance. That's $4,800 in cash you need to bring, just for this one section of the closing costs. This is money that goes beyond your down payment and lender fees. This is the prepaid and escrow category that causes so much confusion and anxiety. Now, can you do anything about this? A little. While you can't change your property tax rate, that's set by your local government, you absolutely can shop around for homeowners insurance. Don't just go with the first quote you get, or the company your real estate agent recommends. Get at least 3 to 5 quotes from different insurance carriers. The difference in premiums can be hundreds, sometimes even thousands of dollars per year. A lower insurance premium not only saves you money on that big upfront payment, but also lowers your monthly mortgage payment for the entire life of the loan. It is one of the few variables in this process that you have direct control over, so take advantage of it. For some borrowers, typically those with a down payment of 20% or more and a great credit score, there's an option to waive escrow altogether. This sounds tempting. You wouldn't have to come up with that huge initial deposit at closing, and your monthly payment to the lender would be lower because it wouldn't include taxes and insurance. But it comes with a massive responsibility. It means you are responsible for saving up and paying those huge property tax and insurance bills yourself when they come due. If your annual taxes are $6,000, you have to make sure you have that money ready to send to the county tax collector. Many people prefer the forced discipline of the escrow account. It's a set it and forget it system that prevents a financial catastrophe if you forget to pay the tax man. So the escrow account isn't a fee, it's a forced savings plan. The nasty surprise isn't the existence of the plan, but the massive initial deposit required to get it started, which is dictated by your closing date and when your local taxes are due. Now you understand how the bank protects its investment and how the government gets paid. But there's a whole other category of costs designed to protect your investment. We're talking about the fees that ensure the seller actually has the legal right to sell you the property and that no one else can come along later and claim it's theirs. This is the world of title insurance and settlement services, a labyrinth of charges that are just as confusing and just as costly as everything we've covered so far. And hidden within these fees are some of the most negotiable costs on your entire statement, if you know where to look. So let's pull back the curtain on that exact statement. Where do you look? The answer is hiding in plain sight on your loan estimate, in a section ominously titled, Services You Can Shop For. This is where the game is won or lost. These are the third-party fees, charges from companies other than your lender, that are absolutely essential to closing the deal. And because your lender doesn't control their pricing, you have the right, and frankly the obligation to yourself, to find a better deal. At the very top of this list, the undisputed heavyweight champion of third-party closing costs, is title insurance. This is one of the most expensive and most misunderstood fees you will pay. So let's break it down. When you buy a car, you get a title. It's a single piece of paper that proves you own it, free and clear. A house is infinitely more complex. The title isn't one document. It's a long, tangled chain of ownership stretching back decades, sometimes centuries. What if, 50 years ago, a forged signature on a deed meant the person selling the house to your seller never actually owned it? What if there's a hidden lien from an unpaid contractor from a kitchen remodel 10 years ago? Or a long-lost heir who suddenly appears with a valid claim to the property? Any of these issues, called a cloud or defect on the title, could jeopardize your ownership of the home. A title search is the first step. A company called a title company sends researchers to dig through public records, deeds, mortgages, wills, divorce decrees, court judgments, tax records, everything they can find related to your property. They are looking for any red flags, any breaks in that chain of ownership. This search costs money, typically a few $100s. But the search isn't a guarantee. People make mistakes. Records get lost. Forgery happens. That's where title insurance comes in. It's a one-time premium you pay at closing that protects you and the lender from financial loss due to a title defect that was missed during the search. Now here's the critical part. There are two different title insurance policies. The first is the lender's title insurance policy. This is not for you. It protects the lender's investment in your property. If a title issue pops up and you lose the house, this policy ensures the bank gets their money back. Because it protects them, they make it mandatory. You have no choice but to buy it. The second policy is the owner's title insurance policy. This one protects you. It protects your equity, your down payment, your future in that home. If a title claim arises after you've closed, your owner's policy will cover the legal fees to fight it, and in a worst-case scenario, will compensate you for the value of your home. While it's technically optional in many cases, buying a home without an owner's title policy is like driving a new car off the lot without car insurance. It is a massive, unnecessary risk for what is likely the biggest financial asset of your life. So, how do you save money here? First, you shop around. The company that provides the title services is almost always your choice. Don't just accept the company your realtor or lender recommends. Call at least 3 different title companies or settlement agents in your area and ask for a quote on their fees. The insurance premium itself is often regulated by the state, but the associated service fees, the settlement fee, the title search fee, can vary wildly. Second, ask for the reissue rate or reissue discount. If the seller has owned the property for a relatively short time, say less than 10 years, there's a good chance their owner's policy is still on record. The title company doesn't have to do a full search back to the dawn of time. They just have to search from the date of the last policy. This saves them work, and the reissue rate passes some of those savings on to you, sometimes cutting the cost by 20% to 60%. But you often have to ask for it. Next up on the shopping list is the settlement fee, sometimes called the escrow fee or closing fee. This is the fee you pay to the neutral third party who actually handles the closing itself, the title company, escrow agent, or closing attorney. Think of them as the overworked referee in the middle of a complex transaction. They are responsible for making sure all the I's are dotted and T's are crossed. They hold the money in a trust account, coordinate with your lender, get the final payoff amount from the seller's mortgage company, prepare the final closing statement, ensure all documents are signed correctly, and make sure that when the dust settles, the seller gets their money and you get a clean title to your new home. For this incredibly important coordination, they charge a fee, which can range from a few hundred to over $1,000. Again, because you can choose your settlement agent, you can shop this fee. When you're calling around for title insurance quotes, you're also getting quotes for this settlement fee. In some states, particularly on the East Coast, a real estate attorney is required to be involved in or even conduct the closing. Their fees will be a separate line item. Even if not required, you might choose to hire one to represent your interests, review the contracts, and make sure you're protected. Attorney fees can be a flat rate for the closing or an hourly charge. The key to controlling this cost is to clarify the fee structure up front. Don't be afraid to ask exactly what their fee covers and what might trigger additional charges. Now we move into the smaller but still significant third-party fees. You'll see recording fees. This is a government charge, not a company fee. After you sign that mountain of paperwork, the deed and the mortgage need to be officially recorded with the county government. This is what makes your ownership part of the public record. You can't negotiate with the county clerk, so this fee is what it is, but it's important to know it's a legitimate, non-negotiable pass-through cost. You might also see a survey fee. This pays for a surveyor to come out to the property and create a map that confirms the property boundaries, locates all the buildings and improvements, and identifies any easements or encroachments. Lenders sometimes require a recent survey to ensure the house is actually within its legal property lines. You can sometimes save money here by asking the seller if they have a recent survey that you can use. If it's acceptable to the title company and the lender, you might be able to avoid paying for a brand new one. Then you have the grab bag of inspection fees. Depending on your location and loan type, you might see a pest inspection, a well water test, a septic system certification, and so on. These are services performed by independent inspectors to ensure the home is safe and meets the lender's requirements. While the fees for each are usually just a couple $100s, they add up. Finally, we come to the dark alleys of the closing statement, the miscellaneous administrative or junk fees. These are charges from the title company or lender for the cost of doing business, often broken out into a dozen tiny, confusing line items. You might see things like a courier fee to transport documents, a document preparation fee, even though you're already paying a settlement fee, an email fee, a processing fee, or a notary fee. These are the fees you should scrutinize with a microscope. Ask what each one is for. If you see a $50 courier fee in an age of digital documents, question it. If there's a separate signing fee on top of the main settlement fee, ask why. Many of these are pure profit centers and are the most likely to be reduced or removed entirely if you push back, especially if you have a competing offer from another title company that doesn't nickel and dime its customers. By understanding that this entire category of costs is up for grabs, you shift from being a passenger to being the pilot of your own transaction. Remember our two buyers, Sarah and Tom? Sarah trusted the process and accepted the providers her agent suggested. Tom spent one afternoon making 5 phone calls, getting quotes, and asking about reissue rates. He ended up with a title company that charged $300 less for the settlement fee and got him a $500 reissue discount on his title insurance. For 2 hours of work, Tom is walking into his new home with an extra $800 in his pocket. But even after you've negotiated every fee and shopped for every service, there's another giant bucket of cash you need to bring to the table. These aren't fees for services already rendered. They're payments for the future. We're talking about your prepaids and the initial funding of your escrow account, and understanding how this money trap works is the next critical step in mastering your closing costs. So let's pull back the curtain on this so-called money trap. It's a trap not because your lender is trying to scam you, but because it's one of the most poorly explained, cash-intensive parts of the entire home buying process. It's where thousands of your dollars seem to vanish into thin air, paying for things you haven't even used yet. This is the world of prepaids and escrows. First, let's tackle the prepaids. The name says it all. You are paying for items in advance. The two big ones are your homeowner's insurance and your daily mortgage interest. Let's start with homeowner's insurance. Before a lender gives you hundreds of thousands of dollars, they need an ironclad guarantee that their investment, your new house, is protected from disaster. Fire, hail, a tree falling through the roof, you name it. They can't risk the collateral for their loan being destroyed and uninsured. So they make a simple, non-negotiable demand. You must pay for your entire first year of homeowner's insurance coverage upfront, at the closing table. Think about it. If they let you pay monthly, and you miss a payment in month 2, the policy could lapse. If a fire breaks out in month 3, the lender is left with a worthless, smoldering pile of rubble and a massive loan to you. They will not take that risk. So, if your annual insurance premium is, say, $1,800, you are writing a check for that full amount at closing. It's not a fee. It's not a deposit. It's you buying a full year of protection, starting from the moment the keys are in your hand. This is the first big chunk of future money you have to bring to the table. Now for the second prepaid item, and this one trips up almost everyone: prepaid mortgage interest. This requires a little bit of a mental backflip, because mortgages are paid in what's called arrears. That's a fancy way of saying you pay for the month that just passed, not the month ahead. When you pay your rent on July 1st, you're paying to live there for the month of July. But when you make your mortgage payment on July 1st, you're paying the interest that accumulated during the month of June. So here's the puzzle. Let's say you close on your new home on May 20th. Your first full mortgage payment won't be due until July 1st. That July 1st payment will cover all the interest for the month of June. But what about the interest for those days in May? From May 20th to May 31st? You lived in the house, you had the loan, so interest was definitely accumulating. Who pays for that? You do. Closing. This is your prepaid interest. The lender calculates the exact amount of interest your loan accrues per day, the per diem interest, and multiplies it by the number of days left in the month of closing. If your daily interest is $40 and you close with 11 days left in the month, you'll owe $440 in prepaid interest at the closing table. And here's a pro tip that can save you a significant amount of cash at closing. Try to schedule your closing for the very end of the month. If you close on the 30th, you only have to pay 1 or 2 days of prepaid interest. If you close on the 2nd, you're on the hook for nearly a full month's worth. This doesn't change the total amount of interest you'll ever pay, but it dramatically reduces the amount of cash you need to bring to the table on closing day. And when you're bleeding cash from a dozen different places, every little bit helps. So those are the prepaids. Now let's talk about their big, intimidating cousin, the escrow account. If prepaids are about paying for the immediate future, escrow is about saving for the distant future. An escrow account, sometimes called an impound account, is essentially a forced savings account for your house that your lender manages for you. Every single month when you make your mortgage payment, it's not just one payment. It's a payment made of 4 parts, often remembered by the acronym PITI: principal, interest, taxes, and insurance. The principal and interest go to the lender to pay down your loan. But the taxes and insurance portion, that gets diverted into your escrow account. It just sits there, accumulating month after month, until your property tax bill and homeowner's insurance premium are due. When they are, the lender pays them for you on your behalf using the money from your escrow account. So why do they do this? Why can't they just trust you to save for these big expenses on your own? The answer is simple: risk. The same reason they make you prepay your first year of insurance. 2 things can threaten a lender's claim on a property more than anything else: a catastrophic loss, which insurance covers, and unpaid property taxes. If you fail to pay your property taxes, the local government, the county, or the city can put a lien on your property that, in most cases, takes priority over the mortgage. They can even foreclose and sell your home to collect the back taxes, wiping out the lender entirely. Lenders are not in the business of hoping you're a good saver. They are in the business of eliminating risk. The escrow account is their tool to ensure the 2 most critical bills associated with your home are always paid on time. This all sounds reasonable enough, right? So where does the trap come in? It comes from the initial funding of the account at closing. You see, you can't start a savings account with $0 and expect to pay a $2,000 bill next month. You have to seed the account with a significant chunk of cash right from the start. At closing, you will be required to deposit several months' worth of property tax and insurance payments into the new escrow account. How many months? Well, federal law allows the lender to collect enough to cover the bills, plus a cushion of up to 2 additional months' worth of payments. This 2-month cushion acts as a buffer in case tax rates or insurance premiums suddenly spike. Let's run the numbers because this is where the sticker shock happens. Say your annual property taxes are $4,800, which is $400 per month, and your annual homeowner's insurance is $1,800, which is $150 per month. Your total monthly escrow deposit is $550. The lender looks at the calendar. They see your first big property tax installment is due in 6 months. Over the next 6 months, you'll only make 5 escrow payments of $550 each, for a total of $2,750. But the tax bill is, say, $2,400. That leaves you with only $350 in the account after the bill is paid. That's not even close to the 2-month, $1,100 cushion they are legally allowed to keep. So, to make the math work, they will collect the difference and then some from you at closing. This could easily be another $2,000 or $3,000 you need to bring to the table. And this is the moment of ultimate confusion for almost every homebuyer. You look at your closing statement and you see 2 massive insurance charges. You see the $1,800 prepaid premium for the full first year. Then you see another charge for, say, $450 to seed the escrow account for future insurance. You scream, "Why am I paying for insurance twice?" And this is the secret: you're not. The prepaid premium is paying for year 1. The money going into your escrow account is the very beginning of saving up for year 2's premium. It's your money, held in your name for your future bills. But because it all has to be paid at the same time on the same day, it feels like you're being double charged. You're paying for the past, the present, and the future all in one crushing afternoon. So let's break it down one last time. Third-party fees and lender fees are for services already rendered. Prepaids and escrow funding are for services and obligations yet to come. They are fundamentally different, but they all demand your cash on the same day. Mastering your closing costs means understanding that you're not just paying off the people who got you to the finish line. You're also pre-funding the journey ahead. But we're not done. We've paid the surveyors, the appraisers, the lawyers, and the lenders. We've funded our future tax and insurance bills. There's still one more entity with its hand out, waiting for its cut: the government. And their slice of the pie, the transfer taxes and recording fees, is just as mandatory and just as expensive. This is where the home buying process gets personal, because these government fees are wildly different depending on where you live. They're a perfect example of the saying, all real estate is local. Let's start with the big one, transfer taxes. Think of a transfer tax as the government's toll for using its official highway to move property ownership from one person to another. The seller, Sarah, owns the house. You, the buyer, want to own it. To make that switch official and legally binding, you have to pay a tax on the transfer of the title. It's a pure revenue generator for states, counties, and sometimes even cities. They use this money for things like schools, roads, and emergency services. So while it feels like a painful cash grab, it is, in theory, funding the community you're about to join. The first question everyone asks is, how much is it? And the answer is a frustrating, it depends. It's almost always calculated based on the sale price of the home. Some places use a simple percentage. For example, the state of Delaware charges a 4% transfer tax. On a $400,000 home, that's a staggering $16,000. Now, before you panic, that cost is customarily split 50-50 between the buyer and seller, but even so, an $8,000 fee just for the privilege of buying a home is a massive closing cost. Other places use a different formula, often called a millage rate, or a rate per a certain amount of value. For instance, Pennsylvania has a 1% state transfer tax, but then most municipalities add their own. In Philadelphia, the city adds another 3.278%. That brings the total transfer tax to over 4.25%. On that same $400,000 home in Philly, you're looking at a $17,000 tax bill. Then you have states like Florida, which charges 70 cents for every $100 of the sale price. On our $400,000 example, that works out to $2,800. It's significantly less than in Delaware or Philly, but it's still a major expense you have to plan for. This variability is why you can't just use a generic online closing cost calculator and expect it to be accurate. The difference between buying a home in Tampa, Florida, and buying one just across the border in Mobile, Alabama, where the transfer tax is only 50 cents per $500 of value, can be thousands of dollars in this one line item alone. Now for the second and arguably more important question. Who pays it? This is where things get interesting. While the government doesn't care who writes the check as long as it gets paid, local customs and negotiations play a huge role. In some areas, it's customary for the seller to pay the entire transfer tax. In others, like we saw in Delaware, it's a 50-50 split. And in some markets, it's common for the buyer to shoulder the whole burden. This is a critical point of negotiation in your purchase offer. If you're in a buyer's market where homes are sitting for a while, you have leverage. You can write an offer asking the seller to pay 100% of the transfer taxes. If they're motivated to sell, they might agree, instantly saving you thousands of dollars at closing. Conversely, in a red-hot seller's market with bidding wars, asking the seller to pay your fees might get your offer tossed in the trash. Knowing the local custom is your first step, and your real estate agent is your best guide here. They'll know what's standard practice in your specific town or county. And just to make it more complicated, some states have what's colloquially known as a mansion tax. This is a supercharged transfer tax that kicks in for properties over a certain value, typically $1 million. In New Jersey, for example, there's a 1% fee on all home sales over $1 million, and it's paid entirely by the buyer. So if you buy a $1.5 million home in Jersey, you're paying a $15,000 mansion tax on top of the regular state and local transfer taxes. New York's is even more complex, with a progressive tax that climbs higher and higher as the sale price increases. The good news? There are a dozen states, including Texas, Utah, and Missouri, that have zero state-level real estate transfer tax. That doesn't mean you'll pay nothing. There might still be small city or county fees, but you're avoiding the multi-thousand-dollar hit that buyers in other states face. Okay, so that's the big government fee. But there's another, smaller one that's just as important: recording fees. If the transfer tax is the toll for using the highway, the recording fee is the cost to officially print your name on the map. Every time a property changes hands, the new deed, the legal document that proves you own the property, must be officially recorded with the county government. Your mortgage agreement, which is a lien against the property, also needs to be recorded. This process creates a public, searchable, and permanent record of ownership. This isn't just bureaucratic red tape. This is the bedrock of property rights in the United States. Recording your deed is what prevents the seller from fraudulently selling the same house to someone else the next day. It's what allows a title company to trace the history of the property and ensure there are no hidden claims or long-lost heirs who could suddenly show up and challenge your ownership. It's a tiny fee for a massive amount of legal protection and certainty. These fees are paid directly to the county clerk or recorder's office. The cost is usually much more modest than transfer taxes. It's often calculated on a per-page basis. For example, it might be $10 for the first page of the deed and $2 for every additional page. You'll pay a fee to record the deed, and another to record the mortgage document. In total, you can typically expect recording fees to be somewhere between $100 and $250. It's not going to make or break your budget, but it's another one of those non-negotiable costs that adds to the final tally. So let's zoom out. The government's take consists of two main parts. First, the transfer tax, which can be a huge expense, is highly variable by location, and is often a key point of negotiation between the buyer and seller. Second, the recording fees, which are a small but crucial cost for making your ownership official and legally sound. Unlike lender fees, which you can shop around for, or third-party fees where you might have some choice in vendors, you can't negotiate these government fees. The tax rate is the tax rate. The recording fee is the recording fee. Your only power here is in negotiating with the seller over who will be responsible for paying them. We've now covered the lender's cut, the third-party professional's cut, the money you prepay for your own future bills, and the government's cut. We've identified all the major players and all their potential fees. The list is long, the numbers are big, and it's easy to feel overwhelmed. You might be wondering, how do I know I'm not being overcharged? How can I be sure that the estimate I got at the beginning of the process actually matches the reality at the end? How do you verify every single dollar before you sign away the next 30 years of your life? It all comes down to one of the most important documents you will ever receive in your home buying journey. A legally required, standardized form that you'll get just days before closing. It is your final best line of defense against mistakes, junk fees, and last-minute surprises. And understanding how to read it is the single most powerful skill you can have at this stage of the game. So let's pull back the curtain on this document. It's called the Closing Disclosure, or CD for short. Think of it as the final binding contract that lays out, in black and white, every single dollar involved in your home loan. The loan estimate you got at the beginning? That was the plan. The closing disclosure? This is the reality. And here's the most important thing you need to know. A right that's enshrined in federal law to protect you. Your lender must provide you with this closing disclosure at least 3 full business days before your scheduled closing date. This isn't a suggestion. It's a non-negotiable rule. That 3-day window is your golden opportunity. It's your time to review, to question, and to ensure that the deal you're getting is the deal you were promised. It's designed to stop lenders from sliding a completely different set of numbers in front of you at the closing table when you're under pressure and just want the keys. So when that email with the CD attached lands in your inbox, don't just file it away. Open it, print it out, grab your original loan estimate, a highlighter, and a calculator. We're going on a treasure hunt for accuracy, and what we find could save you thousands. Let's walk through this 5-page document together, page by page. Page 1 is your executive summary. It's the entire loan at a 30,000-foot view, and it's arguably the most important page. Right at the top, you'll see basic information. Your name, the seller's name, the property address. Check it. A simple typo here can cause massive headaches and delays. Below that, you'll find 3 critical boxes. The first is loan terms. This is the heart of your mortgage. Does the loan amount match what you expected? Is the interest rate the exact rate you locked in? Is the monthly principal and interest payment correct? Is there a prepayment penalty? Is there a balloon payment? For 99% of you, those last 2 should be no. If any of these core numbers are different from what you agreed to, that's a giant red flag. Next, you'll see the projected payments box. This breaks down your total estimated monthly payment, principal and interest, mortgage insurance, and estimated escrow. This is the number you'll actually be writing a check for each month. Does it look familiar? It should be very close to the one on your loan estimate. Finally, on the right side of page 1 is the big one, costs at closing. This section has 2 key numbers. The first is closing costs, which is the grand total of all the fees we've been talking about. The second, and the number that really matters at this moment, is cash to close. This is the exact amount of money you need to have ready for closing day. It's the final figure that includes your down payment, subtracts your earnest money deposit, adds in all those closing costs, and accounts for any credits from the seller. If this number is wildly different from what you were expecting, page 2 and 3 will tell us why. Now let's flip to page 2. The closing cost details. This is the itemized receipt. It's where lenders can hide junk fees if you're not paying attention. The page is broken down into 2 main columns: loan costs and other costs. Loan costs are all the fees associated with getting the mortgage itself. This is where you'll see section A, origination charges. These are the fees your lender is charging you directly for their work. Things like an application fee and underwriting fee, and any discount points you paid to lower your interest rate. Here's the rule. These fees have zero tolerance for change. They cannot increase from what was on your loan estimate. Period. If your underwriting fee suddenly jumped by $200, you need to call your loan officer and ask them to fix it. Next is section B, services you cannot shop for. These are third-party fees for services that your lender requires and chooses the provider for. The classic examples are the appraisal fee, the credit report fee, and the flood certification fee. These fees have a 10% cumulative tolerance. That means, in total, the sum of all the fees in this section can't be more than 10% higher than what was on your loan estimate. A small increase in one fee might be okay if another one went down, but the total can't bust that 10% cap. Then you have section C, services you can shop for. This includes things like the title search, lender's title insurance, and the survey fee, assuming you chose a provider from the lender's list. Just like section B, this category has a 10% cumulative tolerance. The second column, other costs, contains everything else. This includes things like government recording charges, transfer taxes, your homeowner's insurance premium, prepaid daily interest, and the initial deposits for your escrow account. These fees have a bit more flexibility because many are determined by the government or your closing date, but they should still be in the same ballpark as your estimate. Pay close attention to the escrow deposit. Make sure it correctly reflects the amount needed for property taxes and homeowner's insurance. Okay, deep breath. Let's move to page 3. This page can look intimidating, but its main job is simple: to show you how they calculated your cash to close number from page 1. It's the final math problem. It starts with the sale price of the home, then adds and subtracts a bunch of numbers in a table called summaries of transactions. This is where you must verify your credits. Did you pay a $5,000 earnest money deposit when your offer was accepted? It should be listed here as a credit to you. Did the seller agree to pay $10,000 towards your closing costs? It absolutely must be listed here as a credit. A missing seller credit is one of the most common and costly errors found on a closing disclosure. This page reconciles everything: your down payment, your loan amount, your deposits, your credits, to arrive at that final bottom line number you need to bring to the table. Page 4 is the fine print, the additional information about this loan. Don't just skip it. This is where you'll find out crucial details about the long-term life of your loan. It will state whether your loan is assumable, meaning someone could take it over from you in the future. It will detail your lender's late payment policy, what the fee is and when it kicks in. It will also confirm whether you have an escrow account and what it covers. Reading this page now can save you from a nasty surprise in year 5 or year 15 of your mortgage. Finally, page 5. This is the loan calculations and contact information page. It shows you the total amount you'll have paid over the life of the loan, the annual percentage rate or APR, and other figures. But most importantly, it lists the name, address, and license number for every single professional involved in your transaction: the lender, the mortgage broker, the real estate agents, the closing agent. This is your roster. If you have a question, this page tells you who to call. At the very bottom, you'll see a line for your signature under Confirm Receipt. Signing this does not mean you accept the loan. Let me say that again. Signing this does not obligate you to anything. It is simply a legal acknowledgement that you have received the document, and it officially starts your 3-day review period. So, you have the closing disclosure in one hand and your original loan estimate in the other. Now the real work begins. You are going to compare them line by line. Check the spelling of your name. Check the loan type. Check the interest rate. Then go straight to the fees on page 2. Did the lender's origination charges in section A go up at all? They shouldn't have. Did the total of section B, the services you couldn't shop for, go up by more than 10%? That's a problem. Did any fee change that your loan officer can't give you a very clear, very legitimate reason for? Question it. If you find a mistake, if a number looks wrong, if a promise credit is missing, what do you do? First, don't panic. The vast majority of these are honest clerical errors. Second, call your loan officer immediately. Not your real estate agent. Your loan officer. They are the ones who prepare this document. Be polite but firm. Say, I'm comparing my loan estimate to my closing disclosure, and I see a discrepancy on page 2. The underwriting fee is listed as $900, but on my loan estimate it was $750. Can you please explain that change? If the error is significant, or if changes are made to the loan's APR, the loan product, or a prepayment penalty is added, the lender is legally required to issue a new closing disclosure and give you a new 3-day review period. Yes, this could delay your closing, but that delay is a protection. It ensures you have time to understand any last-minute changes before you sign on the dotted line for the biggest purchase of your life. This document is your power. Understanding it, questioning it, and demanding its accuracy is how you walk into closing day with confidence, not anxiety. So you've done the hard work. You've scrutinized every line of your closing disclosure. You've challenged the junk fees. You've confirmed the numbers. Now it's time to walk into the final boss battle. Closing day. But because you did your homework, you're not walking in with a flimsy wooden sword. You're walking in with a full set of armor and a detailed map of the terrain. The very first step on closing day, or sometimes the day before, is one of the most underrated but critical parts of the entire process, the final walkthrough. Do not skip this. I repeat, do not skip the final walkthrough. This is your last chance to see the property before it legally becomes your problem. The sellers have moved out, and you need to confirm the house is in the same condition you agreed to buy it in. Imagine this. You skip the walkthrough because you're busy. You go to closing, you sign everything, you get the keys, and you drive to your new home, dreaming of where you'll put the sofa. You open the door and discover the sellers, in their infinite grace, knocked a giant hole in the wall while moving their king-sized bed. Or worse, you find that a pipe under the kitchen sink decided to burst yesterday, and there's an inch of standing water warping your new hardwood floors. Who pays for that? If you've already closed, it's you. The deal is done. The final walkthrough is your last line of defense. So what are you looking for? First, check that all the repairs the seller agreed to in the contract have actually been completed. Got receipts? Great, but verify with your own eyes. Second, make sure everything that was supposed to be included in the sale is still there. Are the appliances you negotiated for still in the kitchen? Did they take the custom window blinds that were supposed to stay? Third, do a quick systems check. Turn on the heat and the AC. Run the faucets, flush the toilets, flip on the light switches. Open and close the garage door. You're not doing a full-blown inspection, but you are making sure nothing has drastically changed or broken since your last visit. If you find an issue, you call your real estate agent immediately. This is a massive point of leverage. You have not signed the final papers yet. You can delay closing or demand a credit from the seller to cover the new repairs. It's a powerful position to be in, but you only get it if you do the walkthrough. Okay, walkthrough complete. Everything looks good. Now you head to the title company or attorney's office for the main event. What do you need to bring? This is your closing day checklist. First, 2 forms of government-issued photo ID. A driver's license and a passport are perfect. They need to verify without a shadow of a doubt that you are who you say you are. Second, and this is the big one, the money. You will bring your down payment and closing costs in the form of a cashier's check or a wire transfer. You cannot bring a personal check. It won't be accepted. Now, a critical warning about wire transfers. Wire fraud is the single biggest threat in real estate transactions today. Scammers will create fake emails that look exactly like they're from your title company or lawyer, giving you new fraudulent wire instructions. If you send your life savings to that account, it is gone. Forever. There is no getting it back. So, how do you protect yourself? You must verbally confirm the wire instructions. Call the title company using a phone number you know is legitimate, like the one from their official website or one your agent gave you weeks ago. Do not use the phone number in the email with the wire instructions. Call and say, I'm calling to confirm the wiring details for the Johnson property closing. Read them the account and routing numbers. Have them read them back to you. It's a 5-minute phone call that can save you from financial ruin. What else do you bring? A copy of your contract and your final closing disclosure. You'll be signing an official version there, but you want your own copy to reference. And finally, bring your personal checkbook. Why? Sometimes there are tiny last-minute adjustments of a few dollars. It's easier to write a small personal check for $57 than to get a whole new cashier's check. You walk into the room, and it can feel a little intimidating. There's a big table, a stack of papers that looks like the manuscript for a novel, and a few other people. Let's demystify who's there. You'll have the closing agent, also called a settlement agent or escrow officer. This person is the neutral third-party quarterback of the whole process. They don't work for you or the seller. They work for the transaction itself, ensuring everything is legal, signed, and all the money goes to the right places. You'll also likely have your real estate agent there for support, and the seller might be there with their agent, though it's increasingly common for buyers and sellers to close at separate times. Now, for the mountain of paper. You are going to feel an immense pressure to just sign. Don't. This isn't the time to be shy. Your closing agent's job is to explain every single document to you. Let's break down the most important ones you'll see. First, the promissory note. This is the simplest but most powerful document you'll sign. It is your IOU to the bank. It's a straightforward contract where you promise to repay the loan. It will clearly state the total amount you borrowed, your interest rate, your monthly payment amount, and the dates those payments are due. When you sign this, you are legally bound to that debt. Second, the mortgage or deed of trust. If the promissory note is the IOU, the mortgage is the or else. This is the security instrument. It's the document that ties your loan to your new house. It gives the lender a security interest in your property, meaning if you fail to pay as promised in the note, they have the legal right to foreclose and take the house. The name of this document, mortgage or deed of trust, depends on what state you're in, but its function is the same. It's the collateral that makes the lender feel safe, giving you hundreds of thousands of dollars. Third, the deed. This is the one you've been waiting for. This is the legal document that officially transfers ownership of the property from the seller to you. The closing agent will work to get this recorded with the county, and once that happens, you are the official legal owner of that home. There's a real sense of gravity when you see the seller's name being replaced by yours. This is it. This is the moment it becomes real. You'll also sign a final official copy of the closing disclosure. It should look identical to the one you approved 3 days prior. You're simply attesting that you received it, and that the numbers are correct. You'll also sign an initial escrow statement, which breaks down your first year's escrow payments, showing exactly how much will go to property taxes and homeowners insurance each month. The rest of the documents are a series of affidavits and disclosures. You might sign a document swearing you are who you say you are, another one stating that you intend to live in the home as your primary residence, and another acknowledging details about the property. For each one, it is perfectly acceptable, and frankly, it is smart to stop the closing agent and ask, "Can you explain in plain English what I am signing right now?" A good closing agent will be happy to do it. Once the last page is signed, you're almost there. You hand over that massive cashier's check. The closing agent then becomes the world's most important accountant. They take your money, combine it with the money from your lender, and disperse it all. They pay off the seller's remaining mortgage, they pay the real estate agent's commissions, they pay the title insurance fees, they pay themselves, and they give whatever is left over to the seller. When all the checks are cut and the lender has officially funded the loan, the deal is done. The transaction is complete. And then comes the best part of the entire process. The seller or their agent will slide a set of keys across the table. Your keys to your home. The feeling is indescribable. It's a mix of relief, exhaustion, excitement, and a little bit of terror. You did it. You navigated the entire complex, confusing, and costly process of getting a mortgage and buying a home. You've survived closing day, you have the keys in your hand, and the house is yours. But believe it or not, your journey with closing costs isn't quite over. There are some hidden financial surprises that can pop up after you move in. And even more importantly, there are some powerful ways you can actually get some of this money back in your pocket through tax deductions. That's exactly what we're tackling next. The post-closing costs and benefits you absolutely need to know about. Alright, you've done it. You've signed the mountain of paperwork, your hand is cramping, the keys are in your palm, and your bank account. Well, let's just say it's seen better days. That feeling right after closing is a strange mix of exhilaration and sheer financial terror. You own a home, but you've just spent more money in a single day than you probably ever have before. Now comes the next phase. The one where you're not just paying for the house, but you're living in it. And this is where the story of your costs doesn't end. But it takes a fascinating and frankly rewarding turn. Because while you've just paid out all this cash, the US tax code has a few secret handshakes for homeowners, ways for you to claw some of that money back. Think of it like this. The government actively wants to encourage homeownership. And one of the biggest ways they do that is by offering you some significant tax breaks. This isn't some loophole. It's a built-in feature of the system designed for you. And understanding it can save you thousands of dollars, especially in your first year of owning a home. Let's start with the big one, the heavyweight champion of homeowner deductions, mortgage interest. Every single month when you make that mortgage payment, a huge chunk of it, especially in the early years, isn't going toward the principal, the amount you actually borrowed. It's going toward interest. It's the lender's profit. The good news? The IRS lets you deduct the amount you pay in mortgage interest from your taxable income. In your first year, this can be a massive number. At the end of the year, your lender will send you a form called a 1098. This form is your golden ticket. It will literally tell you the exact amount of mortgage interest you paid that year. You just take that number and plug it into your tax return. For many new homeowners, this deduction alone is enough to make it worthwhile to itemize their deductions rather than taking the standard deduction, potentially lowering their overall tax bill by a significant margin. Next up, another hero of your tax return, property taxes. Remember those prorated property taxes you paid at closing? And the money you've been putting into your escrow account every month to cover future property taxes? Well, that's deductible too. The amount of property tax you can deduct is based on what was actually paid to the local government during the tax year. Your closing statement will show what you paid at the settlement table, and your year-end escrow statement from your lender will show what they paid on your behalf. There is a catch here though. It's called the SALT cap, which stands for state and local taxes. Currently, the federal government caps the total amount of state and local taxes you can deduct, including property, income, and sales taxes, at $10,000 per household per year. For people in high-tax states, this cap is easy to hit, but for many others, deducting property taxes still provides a substantial benefit. Now, let's get to the one that directly relates to the closing costs we've been dissecting. This is the one most people get confused about, but it can be the most powerful of all: mortgage points. Remember when we talked about paying points to buy down your interest rate? We defined it as prepaid interest. And that's exactly how the IRS sees it. Because it's interest, it's deductible. But how you deduct it is where the strategy comes in. You have two options, and which one you can use depends on your specific situation. Option 1 is the home run. It's deducting the entire cost of the points in the single year you bought the house. Imagine you paid $6,000 for points at closing. Under the right circumstances, you could deduct that full $6,000 from your income for that year, on top of all the regular mortgage interest you paid. This can be a huge windfall. But to do this, you have to meet a set of criteria laid out by the IRS. Don't worry, they're pretty straightforward. First, the loan must be for your primary residence, the home you actually live in. Second, paying points must be an established and common practice in your area, which it is in most of the country. Third, the points you paid can't be unusually high. Fourth, you must have paid the points with your own funds, not with money rolled into the loan. This means the cash you brought to closing, your down payment, and other costs must be at least as much as the cost of the points. For most standard home purchases where the buyer has a down payment, these conditions are met. And if they are, you get to take that immediate powerful deduction. But what if you don't meet those criteria? What if it's a refinance or a second home? Or what if the seller paid the points for you? That brings us to option 2, deducting the points over the life of the loan. This is called amortizing the deduction. So if you have a 30-year mortgage and you paid $6,000 in points, you would deduct a small piece of that each year. You'd take the $6,000, divide it by 30 years, and you get to deduct $200 per year. It's not as immediately impactful as the first option, but hey, $200 is $200, and it adds up over time. It's crucial to know which rule applies to you. And this is where a good tax professional can be your best friend. So to recap the big 3 tax benefits: mortgage interest, property taxes, and mortgage points. These are the post-closing gifts that keep on giving. However, it's just as important to know what you can't deduct. Most of those other closing costs we talked about, the appraisal fee, the inspection fee, title insurance, attorney fees, home insurance premiums, are generally not deductible. The IRS considers these part of the cost of acquiring the property. But don't just throw those numbers away. They're not useless. While you can't deduct them year to year, you can add them to the cost basis of your home. What does that mean? It means when you eventually sell your house many years down the road, these costs are added to your original purchase price. This reduces your profit on paper, which can in turn reduce the capital gains tax you might have to pay on the sale. So, keep that final closing disclosure statement somewhere safe. could save you a lot of money someday. Now, beyond taxes, there's another category of post-closing costs: the reality of homeownership. The closing table is just the starting line. Now you have to maintain the thing. A leaky faucet, a furnace that goes out in the middle of winter, a roof that decides it's had enough. These are the true ongoing costs. Financial experts often recommend setting aside 1 to 3% of your home's purchase price every single year for maintenance and repairs. So for a $400,000 house, that's $4,000 to $12,000 a year you should have earmarked just for keeping the house in working order. This isn't a closing cost, but it's a cost that starts the second you close. It's the financial reality check that follows the home buying dream. You've navigated the maze of fees, you've signed the papers, and now you understand how to leverage the tax code in your favor. You've transformed from a confused homebuyer into an empowered homeowner. But there's one final step. We've covered dozens of individual costs, concepts, and strategies. How do you put it all together into a single actionable plan? How do you walk into this process from the very beginning with a master checklist that ensures you don't miss a single thing, you ask all the right questions, and you save every possible dollar? That final piece of the puzzle, your complete homebuyer's battle plan, is what we're assembling in our final part. All right, let's forge this battle plan step by step. This isn't just a list of things to do. It's a strategic sequence designed to put you in the driver's seat. Think of the home buying process in 4 distinct phases, each with its own mission-critical objectives. Phase 1, the pre-game. This is before you've even found a house. This is where you set the foundation for saving thousands. Your first objective: get at least 3, preferably 4 or 5, official loan estimates from different lenders. Not pre-qualifications, not verbal quotes. The standardized, government-mandated loan estimate form. Why? Because this is the only way to compare apples to apples. Line them all up. Look at Section A, origination charges. This is the lender's pure profit. Who has the lowest application fee? The lowest underwriting fee? Ask them directly. Is this origination fee negotiable? Some will say no. Some will hesitate. That hesitation is your opening. The lender who is willing to compete for your business is the one you want to work with. Next, while still in this phase, you need to dissect the third-party fees in Section B. Even though the lender doesn't set these fees, they estimate them. A lender who provides a lazy, highball estimate for things like title insurance and appraisal fees might not be the most detail-oriented partner for your journey. Ask them, which of these third-party services can I shop for myself? The law requires they tell you. This is your first taste of control. You're not just a passive participant. You are actively managing your costs from day one. You are stress testing these lenders to see who is transparent, who is competitive, and who is willing to work with an educated buyer. The one you choose will be your ally through the next phase. Phase 2, under contract. You found the house. Your offer was accepted. The clock is now ticking. The game has changed. Your first move is to revisit that loan estimate with your chosen lender. Ask them to update it based on the specific property address and sales price. Do the numbers still hold up? Now is the time to make a critical decision. Locking your interest rate. A rate lock protects you if market rates go up, but it can also cost you money in the form of rate lock fees or points. You need to ask your loan officer 3 crucial questions. First, what is the cost for this rate lock? And where will it appear on my closing disclosure? Second, for how long is this lock valid? A 30-day lock might be cheaper but risky if you anticipate delays. A 60-day lock provides a buffer. Third, what is your policy if interest rates go down after I lock? Some lenders offer a one-time float-down option, allowing you to snag a lower rate. Many don't. Knowing the answer is non-negotiable. Simultaneously, you execute the plan you made in Phase 1. If you can shop for your own title insurance, start calling title companies now. Get quotes. Don't just accept the one your agent or lender recommends. A few phone calls could save you hundreds of dollars. This is also the moment for negotiating seller concessions. A seller concession is when the seller agrees to pay for a portion of your closing costs. This is negotiated as part of your purchase offer. If you're in a buyer's market, asking for 2 or 3% of the purchase price in concessions is a powerful strategy to reduce your cash to close. You're not asking them to lower the price. You're asking them to help with the fees, which can be a much more agreeable proposition for them while being a massive win for you. Phase 3, the final countdown. This is the most critical phase. By law, you must receive your closing disclosure, or CD, at least 3 full business days before your scheduled closing. This 3-day window is not a suggestion. It is your golden opportunity. It is your last best chance to catch errors and dispute charges. Do not squander it. The moment that CD hits your inbox, your mission is to compare it, line by line, against your most recent loan estimate. They should look almost identical. Here is your closing disclosure red flag checklist. Go through it item by item. Red flag 1. The loan terms. Is the loan amount what you expected? Is the interest rate the exact percentage you locked in? Is the loan term correct 30 years, 15 years? Is it a fixed rate or an ARM? A mistake here is catastrophic. Red flag 2. The origination charges. Look at Section A. Did any of the lender's fees increase from the loan estimate? With very few exceptions, they legally cannot. If a new processing fee or funding fee has magically appeared, you need to get on the phone immediately. Red flag 3. The third-party fees. Look at the services you were allowed to shop for. If you chose your own title company, do the fees on the CD match the quote that company gave you? Now look at the services you couldn't shop for, like the appraisal and credit report. These fees are only allowed to increase by a maximum of 10% from the loan estimate. If your appraisal fee jumped by 20%, that's a red flag. Red flag 4. The escrow account. Check the initial deposit for your property taxes and homeowner's insurance. Does it seem excessively high? Lenders are only allowed to collect a certain cushion, typically 2 months' worth of payments. If they're trying to collect 6 months' worth, that's a red flag that needs to be challenged. It's your money. Red flag 5. Seller credits. If the seller agreed to pay for a portion of your closing costs, is that credit listed correctly on the CD? Is the amount exact? Do not assume it's there. Verify it. If you find a single red flag, you do not panic. You pick up the phone. You call your loan officer and say, "I'm comparing my closing disclosure to my loan estimate, and I have a question about this specific line item. Can you please explain why this charge is different?" Be calm, be firm, and be specific. This 3-day window exists for exactly this reason. Fixing an error now is a simple clerical task. Fixing it at the closing table is a high-stress nightmare that could delay your closing and cost you money. Phase 4. The closing table. The final showdown. You've done the prep work. You've audited the closing disclosure. You are ready, but your vigilance cannot stop now. First, bring your paperwork. Have a printed copy of your final, corrected closing disclosure and your loan estimate. Have your government-issued photo ID and the certified or cashier's check for your closing costs. Second, don't be rushed. The closing agent, while professional, has a schedule to keep. Your only schedule is making sure everything is perfect before you sign. They will present you with a mountain of documents. The most important one is the promissory note, your actual promise to repay the loan. The numbers on that note must match your closing disclosure exactly. The interest rate, the loan amount, the monthly payment. Verify it. Then look at the final settlement statement, often called the ALTA or HUD one. This is the final ledger of every single penny in the transaction. It should mirror your closing disclosure. If you see a new unexpected fee on that settlement statement, a courier fee, a notary fee that wasn't there before, you stop. You point to the line item and you say, "This was not on the final closing disclosure I approved. Can you please explain this charge?" 9 times out of 10, it's a simple mistake that can be removed. But if you don't ask, you will pay it. You have every right to take your time to read what you're signing and to ask questions about anything you don't understand. This is the culmination of your entire home buying journey. It is the moment you officially take ownership. Do not let pressure or a sense of awkwardness rob you of your diligence in these final critical moments. By following this 4-phase battle plan, you transform from a passive passenger into an active, empowered homebuyer. You're not just signing papers, you're executing a strategy. You've vetted your partners, you've negotiated your costs, you've audited the numbers, and you've come to the table prepared. That feeling of control, of knowing you did everything in your power to secure the best possible deal, that is the real prize. The keys to the house are just the bonus. You have navigated one of the most complex financial transactions of your life, and you have done it with confidence. And that is the foundation worth building on.